This week's edition of Selfwealth Live, the technical analysis edition, with Jason McIntosh to my right this time. How are you, Jason?
Hey, Rog, I am good. All good today. Bit of movement in those markets to talk about. I'm sure we've got a few interesting stocks for the viewers today. So, yeah, looking forward to it all.
Looking forward to it. There's a bit of a push up again after we've had a bit of a couple of down weeks. So it's good to see stuff is starting to push up again. Hopefully it continues. But let's see how we go today. So welcome everybody once again on the other side of the line. I'm glad that you're here, and don't forget, obviously. We're a show which we've been doing for about 2 years now, haven't we, Joe? So it's been a while. We're a show that's based on your support, and we love to hear all your great feedback. So don't forget to leave a comment, subscribe to the channel, and obviously give us your good vibes via your live chat right here. So say hello to us over here. If you're a newbie to the show, what we do is we go through the Australian market, we go through the US market, and we go through the Hong Kong market from a price chart perspective, right? So our show is all about technical analysis, and what we like to see on the charts, what we like to read the charts. It's all down to what Jason, how he interprets the charts, obviously. Then if you've got any general questions, pop them in. And then if you've got your tickers as well, pop them in as well, and we'll try and get through all of them, which is the main part of the show, and analysing your tickers. We love to see your tickets. We love to get some ideas from them as well, and hopefully some good ones in there today. All right, guys. So without further ado, let's get on to the disclaimer.
Okay, so everything today, general commentary only, no personal advice in the show. And I'll quickly put up the disclaimer that we have a look at each week. And this just goes through that. General commentary. I'm not part of Selfwealth. My business is Motion Trader, so my details are at the top with licensing, etc. And beneath there, you'll see the Selfwealth disclaimer. Again, general commentary, licensing, all of those important bits and pieces are in there.
Fantastic, thanks, Jace. So my general thoughts always go to. I'll tell you a quick story from this morning, and my son decided that as he was getting dressed. As he was getting dressed in his school, we were asking him to get dressed in his school clothes. He, sometimes they're a bit reluctant to do that, being younger, 6-year-old kid, and I've got another 3-year-old kid who definitely never gets dressed. And even though we were asking him to get dressed, my son came to me and said, "Dad, I've got I think we should follow these rules, all right? And the rule is you have to get dressed otherwise you can't come downstairs." And I thought, as a 6-year-old, that's such a smart thing to come up with. Yes, exactly right. We didn't come up with the rules. That 6-year-old could come up with a rule so smart as in to get dressed. But that immediately made me think about how important it is. Something that I've learned so importantly in trading in the markets is to have rules-based investing, rules-based trading, whatever you call it. But I don't know why, it just made me proud of my son that he came up with a rule about getting dressed. You can't get dressed unless you come downstairs. No, you can't come downstairs unless you get dressed. And then it made me relate to trading. You can't put on a trade, basically. If you're thinking about this show and what we're going to talk about today, you can't put on a trade unless you follow the rules, right? So hopefully that makes sense to people. I know I was jumbling around a bit, but that's my story of the day, right? So.
But it's all about bringing order to things, whether it be in your everyday life, in the market. It's if you're playing sport, it's about bringing structure and order. And some people say, "Oh, well, that's all boring. I just want to seat on my pants," sort of stuff. And that's all. That can all be exciting, but exciting and progressively moving yourself forward in whatever you do are different things. And I think, look, if we want to structure success, often it's around rules and process and consistency and discipline, all those sort of things. The excitement, well, that's kept for other parts of life where it's meant to be exciting. But trading the markets, it's meant to be just the more excitement you bring into it, the more emotion you bring into it, and the more emotion you bring into it, the more trouble you tend to get into.
Yeah, exactly. And yeah, it's one of those things that's such an important thing. I think if you're going to have the carrot at the end of it, following the rules, it might not be so exciting sometimes, but following the rules is a very important part of it all. All right, Jake, let's have a look at the Aussie market to start off with.
Okay, so onto our charts, and the first one up is the ASX 200. And well, last week's breakdown, we spoke about this breakdown last week, and it saw some further selling during the week down to a low on Friday before a bit of a bounce over the last couple of days. The other notable development has been that these moving averages are quickly rolling over, and they may actually cross to the downside towards the end of the week, maybe into next week. But they do have that downward slope to them at the moment. So does this mean we should be preparing for the worst? I've seen commentary about breaks below 50-day moving averages. So that's the red one's a 50-day, the blue one's a 100-day. I've seen commentary around this where people talk about death crosses, where the 50-day crosses the 100-day to describe that situation when they cross over. And it all sounds catchy and it all sounds pretty gloomy. But is it all that helpful? And I think on its own, it's not really all that helpful. Moving averages, as our regular viewers will know, one of my favourite indicators. I talk about them pretty much every week. And I think they can be used to identify opportunity. I think they can be used to help avoid risk. But I think an indicator is only as good as your ability to interpret it. Last week I said the break below these moving averages was a bit like an orange warning flag, and that meant that be alert, know where your exit levels are, but don't panic. Don't panic at this point. Not enough information with the structure, and I think that remains the message now. But simply seeing a market drop below moving averages is on its own, it doesn't mean that the market's going to go into an ongoing bearish decline. The key is what happens now. What happens now? The ASX 200 is below the moving averages. So, do we get a shallow bounce? Do we get a shallow bounce that just sort of ebbs its way off the low, but fails to get back above the moving averages? That would be a bearish sign. That'd be a sign that the rallies are being sold. Or do we get like we saw in April? You get that V-shaped recovery, which would tell us something else again. Or is it like a long bottoming phase, like we saw prices grind sideways for several months back in 23. No one knows what's going to develop here. We need to see how the price action evolves, and then as it evolves, we can get a better feel for the underlying structure. There's enough here at the moment to say be cautious, as we discussed last week, but not enough to justify some of the panic selling I've been seeing in some stocks. I've been managing this for myself by sticking to my plan. Like Rog we're talking about rules before, and that's how I've been managing this sell-off by following my rules, sticking to my plan. I sold a few stocks last week. Some of them sold a couple of stocks yesterday. Some of them were big wins that I'd held for a year or two. Others were modest losses, which I just said, look, enough's enough. That's the exit point. Let's cut them and move them on. Most of my portfolio, though, it's still intact, and the stocks trading above wide trailing stops. And it's all that for me, trying to see off what could be a temporary pause. Much of the selling, as we discussed last week, has been in the financials, which of course is the big four banks are in there. But it's interesting to contrast the financials with what's happening in the materials. So let's have a look at the materials index. So this is where you find the mining stocks. And when you look at this structure is this is a bullish structure. Prices are consolidating around the moving averages. See, the 50 and the 100-day moving averages are rising, and prices are just tracking sideways along the moving averages after a strong run over the last few months. And the other key feature, if we compress this a bit, there's been a big 3-year trading range, which looks like is now starting to break to the upside from. So they're bullish factors for materials, and materials are a significant part of the ASX 200. I think it's hard to see the ASX 200 entering an ongoing bearish phase if materials remain strong. Coming quickly over to the equal weight, so the ASX 200 on an equal weight basis, so the bigger stock and the 200 stock are weighted the same. And what we have here at this point, it's a 7% pullback following a 37% rally. So should we be surprised to see some volatility after a big run? And of course, the answer is no, we shouldn't be surprised. Now, this could develop into something larger, but there's not enough here at this stage to suggest that's likely. At this stage, it looks like a pullback after a big rally. I think the key is, well, let's actually come back over to the ASX 200. At this point, we've got an unpleasant 8% pullback from an all-time high. That in itself isn't a surprising event. There are plenty of examples of similar pullbacks. We just compress the chart. You see lots of these examples of unpleasant and difficult times. And the key is what happens. As I was saying, what happens below these moving averages? I think the performance of materials or the materials sector gives cause for a positive bias. And I also like that the equal weight has been holding up relatively well. For me, Rog, it's about giving my stocks plenty of room to move, trying to see off this pullback and maintaining the discipline to sell if stocks come back to their trailing stops. And as I say, just see how this develops. Now we're below moving averages.
Yeah. All right. So let's get on to the US market then.
So over in the S&P 500, well, we saw some heavy selling towards the back end of last week. That was on Thursday. Prices opened high on relief that NVIDIA came out with good results, and then that rally was just sold all throughout the day. That took the index back to the 100-day moving average, and that's the first time the S&P has touched the 100-day moving average since all the way back here in May. So it's been one of the longest stretches above the 100-day moving averages or moving average. I'll come back to the S&P 500 in a moment. I want to quickly jump to the equal weight as it provides, I think there's an important insight to what's happening over on the S&P 500 equal weight. So when we look at this, the big development here has been the equal weight has broken to the downside from a 2-month trading range. So you can see that range in here. The last 2 months, it's just been tracking sideways along the moving averages. We've been tracking this over the last few weeks, and I've talked about how prices were consolidating along these rising moving averages. I thought the odds favoured an eventual break to the upside, but instead we've got to break lower. And when you're in a range, the break can come in either direction. The equal weight has also been it's been below its moving averages for the last week, and those averages are now starting to turn down. I don't think we can simply ignore these factors and just push them to the side. The breakdown that we have here in the equal weight, I think it's a clear sign of technical weakness, and I think the biggest issue for the US market has been declining participation. And that means fewer stocks are involved in the rally. More stocks are dropping below their own 100-day moving averages. More than half the market is below their 100-day moving average. And I think this breakdown in the equal weight is a clear sign of that softening in the participation. That said, there's still not enough here to say a bearish phase or bear market is inevitable. The key will be whether the market can get back above these moving averages, and maybe this proves to be a false break to the downside, and maybe this is all just a moderate pullback. My biggest concern would be if prices were to become established below the moving averages. and that's where we just get this back and forth price action below the averages, and then that can set up the market for then a larger decline. But that hasn't happened at this stage. That's something that we I think you just need to monitor at this point. So that's something to be aware of. At this stage, I don't think we have the evidence to suggest we're on the cusp of a major unravelling in the market. Just coming back to the S&P 500, as it stands, prices have pulled back. Prices have pulled back by about 5.8%. They're currently rallying off the 100-day moving average. If we got bearish every time we saw a pullback to the moving averages, we'd find it very difficult to stay on longer term trends, because as you can see, prices do come back to these moving averages. Sometimes they go below the averages and then snap back. So it's not enough here at this point to get bearish. There's enough there to be concerned, be watching, be cautious, but there's not enough to get bearish. For a bearish structure to develop, I think we need to see prices below the moving averages, and then would need to see the moving averages start to roll over, would need to see prices get stuck below the moving averages, and then those rallies back to the moving averages failing, the rallies being sold. So there's things to look out for, like the structure we saw back in 2022, below the moving averages, rallies back to the averages being sold. That's your classic bearish structure. We don't have that yet. And we may not get that in the near term either. I think the breakdown in the equal weight and the declining participation are causes for concern, but I don't think they're reason for panic. Near term, I think we should probably expect more volatility, but I think try not to get swept up in other people's fear. I'm seeing a lot of fear from people, and predictions of falls and bubbles, and on the news, nightly news, I'm hearing reports of bubbles and things quite frequently. So not getting swept up in other people's fear. I think know where your exit levels are, follow your plan, make rational, unemotional decisions, and I think that's how we see off these periods and manage our risk.
Yeah, 100%. I totally, it's over the last couple of years, it's especially that earlier pullback this year. I think we all got taught a lot from that earlier pullback this year, that it can dive quite deeply, 20%. And if I recall back to that period, I probably exited about, I don't know, I would have had about 20 positions. I probably exited about 3 or 4 out of that. And a lot of them still survived to today and are in double-digit figures positive, right? So, and of course, that might not happen this time around. It could completely go the opposite way. We could have a crash, as the media is saying, right? They could be right. But I think being able to keep our nerves in this time and knowing what we know through this show, Jason, is so important. And being able to stick to your rules, obviously, when you're entering or exiting, right? So it's a really important factor. So.
Very much. It's like not trying to guess what's going to happen next, but have your plan in place. So if the market does this, well, this is what I'll do. If it does that, well, then this is what I'll do. It's not like going to a chat site and everyone's revving themselves up about how this is going to happen and that's going to happen, getting swept up in that. Sometimes it's euphoria, sometimes it's fear. We want to like try and filter that out and try and keep it systematic, try and keep it unemotional, and stay away from emotional types because it tends to be contagious, and just try and just stick to your plan. Now, that sticking to your plan doesn't mean you don't lose money when the market pulls back. Yes, you lose money, but you have a plan to get out and you have a plan to get back in. But it's when every time there's a pullback, there's panic about this is a big one, and the big one may not come for another 2 years. Like, we don't know. So have the plan, try and see off pullbacks to a reasonable point, then have an exit strategy, and manage your capital systematically, not emotionally.
Yeah, and one thing obviously in this period now, I'm a lot more attentive to the stocks that I hold. If you're holding a portfolio of 20 to 30 stocks, or you might have 60 or 70, Jason, you're a lot more attentive. So you can use a lot more of the technology to alert you around things. Using price alerts, using your charts to its full advantage, so you're on top of the stocks that are going towards your stop losses. Good practice emotionally as well, when you do have to cut a trade, right? And it's all good practice, right? So, all right, let's get on to the Hong Kong markets.
Just quickly over at Hong Kong, we talked about the possibility of a range forming last week, and I think that's what we might be seeing now. Prices just pulling back towards the October low. So we now we do have the makings of a range. To really firm up the range, we'd now need to see prices move back towards the upper end, and then we say, okay, look, we've got two highs, we've got two lows, we've got a range. So maybe that's what we're going to see. I think that near term, we're probably in for more consolidation in the Hang Seng, but this broader trend remains in place. I think the odds favour an eventual break to the upside. And just briefly on the Chinese market, this has become a deeper pullback. Prices had come back to the 50-day moving average and looked like maybe they were getting a bit of a toehold, but now they've come back to the 100-day. It's still within the parameters of a pullback within a rising trend. I think it's important that we do see signs of the dip being bought. Now we're back here at the 100-day moving average, like several other times this year. So you can see there's here's a move back to the 100 and then a quick bounce, move back into between the 50 and the 100 and a bounce. It's happened several times since the April low. Look, I'd favour probably more consolidation, maybe around the moving averages. Maybe it's a case of more sideways consolidation, several weeks, perhaps. But I'd still favour that overall developing upward trend that appears to have been in place for coming up to a couple of years now.
Okay, fantastic. Good to hear. All right, let's get on to a bit of a general question here, Jace. Let's see if you can answer it. So the question is around consolidations, or even worse off, sell-offs. Where do you see the money go, and do you notice like rallies elsewhere?
The money can go all over the place. The money can go into cash. The money can go into other stocks. Sometimes stocks there can be a broader market sell-off and the gold price might rally and gold miners might go up. I don't think there's a set rule. But in a bearish phase, a lot of the money is probably leaving the market and goes to cash. People sell, new people buy, so there's an exchange, but that doesn't necessarily have to be. The people who sell don't have to necessarily be putting it back into the market straight away.
Yeah. All right, fair enough. No worries. Let's get on to the first ticker then. G'day, Kirby. Let's have a look at WR1, please.
Yeah, look, it continues to. I think we looked at this a couple of times. It's an emerging trend. I like that we've had the consolidation along the averages. We've had a breakout, and it's just been tracking sideways over the last week. If I had this one, I'd be happy holding it. Where is the day? It's down on its lows for the day. Maybe there's some more consolidation. I probably wouldn't rush to buy it today. The fact that it's just looking for the open. There's the open, so it's traded high and now it's on its low. So that maybe there's some interest in selling the rally at the moment. So that could just be a case that the consolidation's got longer to go. You could see prices drift back towards the low from yesterday. Maybe a bit more back towards the 50-day moving average. So look, if I had this one, I'd be happy holding it. I'd have my stop back down here below the 100-day moving average most likely, And but I wouldn't hurry to buy it at the moment. If I was interested in it, I'd like to just see how whether this consolidation continues to build out, and if we get more of a you get more of a a consolidation platform develops, and then you can look for a breakout from that. This might have a little bit further to go.
Okay, thank you. Hi, Roberto. Let's have a look at PWN, please. Is there a cup and handle forming?
Yeah, low price stocks. I think it's like the cup and handle. I think we're referring to. Let's see whether I can make this work. So that would be the cup, and this would be the handle. And it's not really how these patterns form. It's sort of like this is all just part of sideways mess, but I think I can see the pattern being referred to. So it's where, like, ordinarily it would have developed because you've probably had like a down trending phase, and then you got this rounding bottom as the lower lows give way to rising highs, and then you get a sideways consolidation, and then you get a breakout from the sideways consolidation. That's the cup and handle. So you can kind of see that sort of picture on this chart, but it's kind of missing that big downward trending phase. We're just trying to like create it out of a market which is been moving sideways for 3 years. So look, probably not one I'd be too excited about. That said, if it were to break above its this previous high, 1.6 cents, maybe there's some upside in it. But look, you can see this has been bouncing along the bottom for there's 2021. So there's a few years of just bouncing along the bottom. If it breaks higher, breakouts, you never know. You never know where they could go. So there could be something there, but it's probably not one for me.
Okay, thank you. Let's have a look at the difference between BHP and Rio, please.
Rio's doing a lot better. The short answer. Quickly, we'll go to BHP first. So BHP looked to be breaking higher about a month ago. Had those nice rising moving averages, and you can see this blue horizontal I've got in here. You can see that there was a high, a low, some lows in mid last year, some technical activity late last year. So it'd been a good sort of level to keep an eye on. We started to break above that, but then just in the last week, it's just lost that momentum and has fallen back below its moving averages. I don't know the news flow around it, but the structure around it does weaken that structure, removes that near term momentum which it was developing. So I wouldn't rush to buy BHP on that price action. I'd want to see it back above its moving averages and before considering it again. With Rio, on the other hand, and Fortescue is also showing encouraging price action. Rio, it looks a bit more like we're seeing the materials index, and that we've had that strong rally off August, September lows. Now we're getting the sideways consolidation along rising moving averages. We just compress this up a bit. You can also say, well, look, you've got these highs. So it's just consolidating below this resistance marker. I think Rio is setting up for a break to the top side. I think there's good upside potential in Rio. That would be my. If I had to choose between one of them at this point, it'd be Rio.
What about since you mentioned it, let's have a look at Fortescue.
Again, you can see those rising moving averages. There's a support resistance region coming in around 1940 thereabouts. So it's broken to the upside of that. It's just come back, just a return move back to the 50-day moving average, consolidating. There's also like a dividend was paid, so that you take the dividend out, and it's an even nicer upward phase. Just return the dividend because that's the normal way to look at the chart. So I think there's There's an emerging trend in Fortescue. Probably a lot depends on what that iron ore price does as well, but there's an emerging trend there. Whether it extends, how much it extends, we don't know at this point, but it's and we never know. So it's a case of like going with breakouts, going with what's working or what's starting to work, and seeing where it goes. If it goes well, keep holding it. If it stalls and starts to come back, well, then maybe move it on and try something else. But yeah, Rio and Fortescue, I think both have that upward potential very much in place at the moment.
Okay, very good, thank you. Hi Sue, just wondering with stocks like PLS, let's check up PLS. What is the best way to find how the lithium price fared overnight, chart-wise?
Lithium doesn't trade on the like. There's not a futures contract for the lithium price like there is for like gold and silver, and even uranium is a little bit simpler to track because there's a uranium ETF, like spot uranium ETF, and but lithium not so much. I think the best way to sort of tell what the lithium market is doing is looking at what the lithium stocks are doing. So one ETF two ETFs I have a look at each morning. They're US listed, REMX and LIT. So they're ETFs full of lithium stocks, and you can see they started to break higher in July, and so this is like global lithium stocks rather than just waiting for the local plays to open up. And LIT, they look quite similar. So I think that's one way to get a good overview of the lithium price generally. But yeah, look, if the stock prices are tracking above rising moving averages, it's telling you there's positivity around the lithium landscape generally.
Okay, thank you. We're going to look at this one as well, PLS.
And we're just talking about this, then it's like, yeah, well, it's trending higher, rising moving averages. It's like it'd be a harder one for me to buy at the moment because it has had a bit of a run, has become a bit stretched above the moving averages, and now just pulling back. So maybe there's some consolidation after this, after the most recent run over the last couple of months. But yeah, I've got some LTR, some Liontown. I'm happy holding that at the moment. Just have a quick look at Liontown. Similar sort of structure. PLS is probably looking a little bit stronger at this point. But yeah, look, the same thing. You've got the rising moving averages, and prices been building along the averages and rallying, then coming back to the averages and rallying. So it's got the upward momentum there. So how long that lasts and how far it goes, we don't know. But I'm happy to just stay on board and see what happens. I'm not interested in taking I think I might have I can actually measure it out. When did I get in? I got in somewhere. Let's say I'm in somewhere around here. So maybe I've got a 50% profit there at the moment. So that's all nice, but I'm not interested in taking that. I'm more interested in I'm prepared to give a good portion of that back, and for the potential of staying on what could be a much larger trend. And, this is the tricky part for a lot of people. They're tempted, they're lured by the 40 or 50% wins. A lot are lured by the 20 or 25% wins as well. But if you're always giving into that temptation, it's hard then to say, well, look, how am I then going to stay in for the 100 or 200% gain? So whether this goes the distance, I don't know, but it's got the potential. So if the potential's there, I want to stay with it and give it lots of room to move around. And because I only need a few stocks to really run 100%, 200%, it really starts to make a strong portfolio, as long as I'm careful with managing risk on the ones that don't work. So yeah, that's my play with this at the moment. Give it the rein to run and give it the room to move.
All right, thank you. Hi Wish, let's have a look at Life 360.
It was a motion trader stock. It hit a motion trader exit last week sometime as it was coming down. We're getting this often happens when when a stock or an index goes from above the moving averages to below. You often get the rebound back towards the moving averages, which we're getting now. The key will be what happens, just like we were talking about with the ASX 200. What happens now we're below the moving averages? Is it is it like April, where you got that initial fall, but then you get that V shape rally back up through the averages and things take off again? It's like this has had such a big run. I just don't know that that's what we're going to get. It's possible, but I think that's probably less likely. Also the fact that it's come back so aggressively. The dip hasn't really been bought. There's a little bit of a sign of buying the dip in October, brief dip, and then it's given way. But there hasn't been that much buying on the way down. What would concern me would be that you just get stuck below the moving averages. They continue to turn, and if it's stuck below the moving averages, then the vulnerability is that you then get further selling. Now, I don't know whether that will happen or not, but it's certainly a scenario I'd be conscious of if I was holding it. If I was holding it, I'd be exiting it because it's hit the motion trader stop loss, trailing stop. That may have been around Wednesday or Thursday last week, and I'd be using this rebound as an opportunity to sell at a better level. So that's what I'd do. That doesn't mean everyone else should do that, because I could be wrong, and maybe it does a V shape and makes new all-time highs. But I'm all about managing risk, and it's like this upward momentum has now been severed by a sharp pullback, and it is, how far is that? 39% pullback. I'd be inclined to say, look, it's just not working for me now. I'll say thanks very much. I've got a rebound back towards the moving averages, and I'll now move on to something else.
Okay.
But again, I stress everyone needs to do what they'll do, because I don't see the future with these things, and but it's just how I'd manage my risk around it. Or alternatively, maybe another strategy would be holding it and saying, look, whilst it's above that low from the 19th, I'll hold, but if it breaks below that, well, then I'll say, look, enough's enough. I'll rule it off then. That could be another strategy. I think the key is it's not so much like making the right call now in terms of, is it going to go up or is it going to go down over the next few weeks? It's like just making sure there's a strategy around exit. So if it does come down, there is a plan. The worst thing that can happen, I think, is to hold a stock like this and then just not have that plan, and then we look at it in 12 months' time and it's trading at $4. I'm not suggesting that's going to happen, but I've seen that sort of thing happen many times, where you get a boom stock and then the boom ends and it's a long deflation, and it ends up giving back 70, 80, 90%. So again, I stress, I don't know, I'm not suggesting that's going to happen here, but that's why I think it's so important to have an exit strategy in mind, so you don't find yourself in that position in times ahead.
Yeah, very good. All right. Hi, Astro. Let's have a look at HLS, please.
Yeah, interesting. So this isn't a motion trader stock at this time. It has been in the past, but it's been sold because it's in a downtrend. Not a stock I'd be holding at the moment. But is it basing? Has it formed a base, and it's made its way back above the moving averages? I like how, look at this price action here. So it's rallied back above the moving averages, and look at this series of rising lows as well. So it's like it's being accumulated on the dips. Every time it comes back, it's bought and pushes to a new high. Now we've got this sideways consolidation along the moving averages. The moving averages are turning. Is that accumulation still going on? Probably a little bit early for me at the moment. I'd give it a little bit more time, but it's if it can continue just to establish along the moving averages, get these averages crossing, get it breaking up to a new high, then that could become a buy for me. Certainly one which I think is worth watching. And look, if somebody does want to be early, like the moving averages, the 50 and 100 day aren't magic. It's not like they have to cross. Like if you're using 40 and 80 days, they're probably already crossed. It's not like magic, but it's just consistent for me. If somebody really wanted to get in early, like it could be bought now, and a stop could be placed maybe. Maybe 17%. So just back below the moving averages, back below these recent lows, back below this strong advance. So you probably back to the base of that strong advance. So if it gives back all those gains, then it really starts to lose some of that dynamic which is forming now. So look, it could be bought now, 17% stop loss. See how it goes. My preference would be to wait, see how it develops a bit more, and then have a look at it. But either way, it's a stock of interest.
Okay, thank you. Silver says Stan Weinstein says bad things happen below the 200 MA. Not yet. Yes, we'll see.
And it's right. My variation of this is all the bad stuff tends to happen below the moving averages, and I'm referring to the 100 and the 50, or the 50 and the 100. So it's like that's right. I think those longer moving averages are great because they're slower to move. They take out a lot of the noise. If you're looking at a 10 or a 20-day moving average, there's a lot of noise in those. Once you start getting to 50 or 100 or even out to 200, like for me, 200 is just a little bit too slow moving. Although there's nothing wrong with it. I think it's a great way to do it as well. But it's. Be careful when prices are below their averages, because that's when the bad stuff can happen or tends to happen. That's when companies tend to surprise with bad news and a downward trend feeds upon itself with more negativity. So buying the dip back to the averages, maybe. Buying the dip below the averages, that's certainly not for me. Or Stan, for that matter.
Fair enough. All right, let's have a look at gold and silver. I think that'd be much of muchness, but let's have a look at them. That's all right, quickly.
Okay. I do these in detail on my Friday strategy session, so that's the place to come if you want an in-depth breakdown on it. At the moment, we've got consolidation along rising moving averages. The trend remains up. The question is, how long could this consolidation go for? Like, has it done enough now, and is it about to break to new highs, or is it going to be something which could have more in it? I think the consolidation could last longer. Like when you look at it on a weekly chart, it's still well elevated above the 50-week moving average. I think there's scope for a longer consolidation. It could make a new high, but this isn't a point I'm excited about buying gold stocks. I'm still long gold. I've got physical gold. I've got GDX, a gold stock ETF. I'm very much still long gold with my core holdings, my longer term holdings. But I've sold some more recent, I'd call them tactical positions, where I just bought as prices were breaking up in August, and sold them when they got stretched and started to come back down. So look, what I'd be doing with gold, it's staying on the overall, it depends what people are doing as well. Like the longer term trend, I think is up. It's just that question of like how long could a consolidation last, and probably not being problem. I found like people sending in emails when we had this pullback. People sending an email saying, "Oh, my portfolio has taken a huge hit," and it turns out that they're predominantly in resource-based stocks. It's like, well, that's all great when you've got this big upward phase, but you've got to remember these are volatile sectors, and when they pull back, they can bite pretty hard. So I'd be careful. I'd be mindful about not being leveraged or or continuing to pile into gold stocks, thinking, well, gold's going to 10,000. It may well do that over the next few years, but it may have an excursion to the downside in the interim. It almost certainly will. So just being careful not to be too aggressive with position sizing, because you've got to be able to see off the consolidations when they come. And the same for silver. I've got a position in a silver ETF, like physical silver. I bought that position. I think I bought that position back in around June, when prices were sort of like rallying off the moving averages, and I just sit with it. It causes some swings in my portfolio because it's so volatile. These pullbacks and the rally, then another pullback, so it jumps around a bit. But I'm not trying to trade in and out during this period. If it's the consolidation is nearly done and we're off to new highs, great, I'm on board. But if the consolidation happens to pull back more, and look, I wouldn't rule out a retest of the 100-day moving average either. Entirely possible. We're in that consolidation phase, and that's when things get tricky. And a bit of caution should be taken not to get too focused on that we're going to get a quick rerun of what we've just experienced. That may not happen in the near term.
All right, thank you. Hi, Langell. Let's have a look at WTC.
Downtrend. Look, it's just a clear-cut downtrend. I would have already sold it had I bought it. Had I bought it on this, like maybe the trend's starting to, like, we're looking back here. Yeah, look, it's establishing above the moving averages, starting to break higher. This is worth some risk. Let's maybe take a position, have a stop loss below the 100-day moving average. Sharp move decline below the moving average. There's a sell point. I'm now out. If I was in, I'm just going hypothetically. I'd be saying, look, that momentum has now been severed, so there's no point being in there. And I'm not looking at buying the dip below declining moving averages. As we just discussed, the bad stuff tends to happen below the moving averages. And here's a perfect example. There's a gap lower below the moving averages. Gaps higher tend to happen above the moving averages. Gaps lower tend to happen below the moving averages. Of course, there's exceptions. Here's an exception over here. It's above the moving average and a gap down. But I think the biggest risk is trying to buy stocks which are declining below averages, because the path of least resistance is lower. If I like this stock, I was interested in it, I just keep watching it. It needs to get back above the moving averages, establish itself, and I won't get in at the low. But I avoid the risk that I buy and it continues to unravel. So I'd steer clear of this one for now.
All right, thank you. Next one, let's have a look at Star Casino Entertainment. Why wouldn't you be in this? How is Motion Trader not looking at Star Casino Entertainment?
I'll tell you why in a minute. What's the code? Star Entertainment, STA. Look, here it is. SGR, that's it. Why would we not be in it? Well, declining moving averages, below the moving averages. It's just like people have been buying this stock. Seriously, people have been buying this stock, trying to call the low the whole way down. Like every time someone sells, someone's buying it. Like look at it, the whole way down. This is going to bottom. Surely there's a bargain to be had here. It just keeps going down. Bad stuff keeps happening below the declining moving averages. And why do we want to punt on this stock? It's just because it's down and out doesn't mean it has to come back. It could get delisted. You don't know. I'm not suggesting it will get delisted because, of course, I don't know. But just because it's down and out doesn't mean it's coming back. It might, but it might not. There'll be no motion trader buy on this until it establishes above the moving averages and the moving averages cross. It's had a few false starts where it looked like maybe it was getting going but couldn't turn the averages around, made new lows. People, I see this one in the news. They'll say, Star was up 15% today. And people go, oh, wow, 15% a day. Look at this. If I get this at the low and I sell it at the high, I can make a quick 48%. But how are you going to get the low and how are you going to get the high? It's like I haven't mastered the magic behind that. And I don't think too many people do. It's like the money's made. The money's made in the upward trending phase and it's lost in the downward trending phase and people trying to pick the lows. So, yeah, it's I think don't get drawn in by you measure it and you go there's a quick 20%, but you're just as likely, you're probably more likely to buy it thinking, okay, I'll just hold on for a quick 20%, and before you know it, you're down a quick 30% or more, and then you're going, well, now how do I get out? Just leave it alone. It's too hard.
All right, thank you. Do we have a Japanese ETF? Japanese ETF that we could look at, Jace?
Well, there will be. I don't know offhand what it is. We can start by having a look at the Nikkei. I actually have the Nikkei here. Yeah, well, uptrend, rising moving averages, all of that. It's been an uptrend for years. Notwithstanding like pullbacks and consolidations, but uptrends are there. It's it continues to trend higher. Having a pullback at the moment, maybe there's more consolidation to come. But you'd have to do a quick search for ASX Nikkei ETFs, and we could have a look. I can't remember them offhand.
We could look at IJP, iShares, MSCI, Japan ETF.
So it looks quite similar to what we just looked at with the Nikkei. Of course, there's currency. The currency is going to make a difference, and in this case, I think the yen's been weakening against the Aussie dollar, I think. So that would mean there's the Aussie, the gain through the ETF probably isn't as much as the Nikkei itself, because because when you buy the Nikkei, you're exchanging your money into yen, and the yen's been weaker. So when you bring it back, you lose a little bit. But nonetheless, that's an uptrend, rising lows, rising moving averages. I'd be happy holding this one. It's whether you buy it now, I'd probably not buy it today just because we've got that global uncertainty and a bit of volatility coming into markets. So it could consolidate in the near term, but I'd be happy holding it uptrend.
All right, thank you. Next one along, ACDC. It's an ETF as well.
Yeah, it's this has been a great performer.
It's a lithium one as well, the one we looked at before, actually.
Yeah, so look, I'd be uptrends in place, pulling back to the averages. I'd probably be inclined not to want to buy it at the moment, just because it looks like there's some consolidation starting, whether it's short or whether it goes on for a bit longer, because it has been a big run. It's up from 86 to 130 in the space of a few months. So it'd be completely normal to get a multi-month consolidation. But yeah, it's certainly a hold. Like there was a nice breakout point here. Like look at that consolidation along the moving averages, and then we got the break higher. So that was a nice entry point around 90. If I was in from good levels, I'd very much be holding it, and it'd be interesting to keep on the radar if a good buying opportunity comes up.
All right, thank you. Next one. Hi, Greg. Let's have a look at WC8.
Yeah, potential emerging trend here. Like the averages have crossed. It's gone from below to above. We've got the sideways consolidation along the averages, break to a new high, now a pullback. The key will be, so far it's holding onto its most recent gains. I see this nice rally off the November low, pullback. It's holding onto most of those gains so far. Like you can put a Fibonacci on that and just say, look, it's just come back to the midpoint. You just take the recent low and the recent high, And that's you just look, if you're not sure what Fibonacci retracements are, just Google them. You'll get plenty of information. It's not saying I use so much for placing trades, but it gives you some broad parameters around where a pullback would proportionally come back to, and this is proportionally coming back to where you'd want in an emerging trend. I'd be happy holding it if I had it. If I didn't have it and I was interested in it, it probably could be. If it was let's just work this through. If it was bought at current levels, probably needs maybe like a 22%, 20 to 22% stop, maybe getting it back below the 100-day. And if it were to give back, so there's those nice gains. If it were to give all those gains back, well, then it really starts to mess around with the emerging trend. Like in an emerging trend, you expect the dips to be bought, but if the rally gets sold all the way back, it loses its appeal quite a bit. So look, that could be one option, buying at current levels. Alternatively, see if maybe there's some more sideways consolidation. Like, it would be not unusual. Like you see, you get these sideways periods. So we could see a bit more of this sort of price action. And then from there, maybe we get a breakout. And then that could be an entry point. But that involves waiting and watching, and it may not even turn out like that. A couple of ways to play it, but well and truly worth holding on to, I think, if I was in it. And it'd be interesting to see whether it continues to develop.
All right, thank you. Next one is IGO, please. From Sol.
Similar sort of situation to what we just looked at. We've had this consolidation along the averages. Now we've got the acceleration higher. It's again, it's one of these potential emerging trends. It's like, I think it's a lithium orientated stock too. So it's similar to what we're seeing the price action in Linetown. It's like has some similarities to that. I'd be holding if I was in. Again, there you can put those fibs on, the Fibonacci's, just come back to that 50% sort of region. It could be like I'd probably be inclined just to watch this one for a bit, just see whether we get that sideways consolidation, let the moving averages catch up. If I was looking at buying it, if I was already in from lower levels, I'm holding it, wide stop back below the 100-day. But if I was looking at getting in, probably just see how, if it consolidates, if it holds onto its gains over the next week or two, maybe that sets a platform for a buy the dip. But one of those stocks which I think does have that upside potential.
Okay, thank you. Can we have a look at MTM, please? There's a bit of a bounce off the 200 EMA. Need to get above the 50 EMA for momentum, but looking for an entry from a swing here.
What I don't like about this, I don't like how quickly it's come back and didn't find support on the way down. So that's like Drone Shield began its decline the same sort of way. Had a big run up and then it turned. It didn't get support on the way down. It continued to unravel. Not suggesting this will do the same thing. We don't know, but it's a warning sign when the dip isn't supported a bit earlier. It's now consolidating below moving averages, which are rolling over. So we say maybe it's bounced off the 200-day, but the thing is we can keep putting moving averages on until we find a bounce at some point and go, it's bounced off the 300 or 400 or the 150. It's always going to be bouncing off something at some point. So I don't want to use too many moving averages. I want to try and keep it as clean as possible. I'm using 50 and 100. And what I'm wary of at the moment is it is consolidating beneath moving averages, which are rolling. I'd be careful with this one. It looks like it could be a bit of a rally in the near term, but is it setting up to make new highs? I suspect that's going to be a longer path back if it happens at all. We may find we get a bounce, but then that bounce might then get sold, and we may find our way back back down. It's not a standout to me, this one. It's the one which, yeah, I'm just not sure this is going to bring a lot of joy in the near term. But look, as always, I can be wrong, and I'm often wrong on things. It's just as long as we can manage risk, I suppose. So we can say, look, if we're really keen on this, and sure, maybe it's bounced off the 200-day moving average. So maybe it's bought at current levels, and there's a 25% stop that takes it below the recent low. So we can manage risk. So the key is risk manageable, and do we think there's enough upside to justify the risk? I'm not sure there is on this one. But maybe it does go off and make new highs before too long. But for me, it's not a standout. But at least we can define some clear risk parameters around that. So it's not like just an open-ended loss if it doesn't work out.
All right, thank you. I think we'll finish up with the for tickers for today, Jace. There's one general question which we've got here at the end, and that is, what do you think the implications of the yen trade collapsing? If that makes sense to you.
Yeah. This has been it's a theme which has come up since the 1990s when I was working at the bank. Yen carry trades. It's like it works because you can borrow money in Japanese interest rates have been near zero for 30 years, and so you could borrow cheap money in Japan and then reinvest in other markets. So there's constant selling of the yen and buying of other currencies. And then periodically there's something happens and there's a reversal of the trend, and the yen quickly soars, and the other markets get sold, money gets repatriated back to buy the yen, which is now appreciating. It's like, I don't know. It's like, it's one of these things which that can lead to sell-offs in markets, but it's not something I'm going to try and predict. Let me just quickly find the Japanese yen. Do I have it on my currency list? Where's my currencies? Here it is here. So look, at the moment, the yen hasn't been. So this is the US dollar versus the yen. So the dollar's been rising, so the yen's been weakening. But at the moment, this is like a sideways holding pattern. It's like, if anything, it looks like it's gearing up for a break higher. So more yen weakness. It doesn't look like one which is about to come crashing down. It's not like there's been this exceptionally strong period which is just overdone and it's due for a correction. It's like at the moment it's sideways, and I think the bias would be to break to the upside. So I don't think that's a wild card event for the markets at this point.
All right. Thanks, Jace. Let's wrap up for today. It's been a good show. A lot of some good ideas in there, as well as some ones maybe not so good right now. We're in a bit of a nervous time in the markets, as we've already explained. But I think the message is a little bit of bad things happen below the declining moving averages, but just to be aware of that. That doesn't mean we're about to crash anytime soon, right? We're still in sort of this territory where we've just got to make sure that we stick to our rules, stick to our trading plan, as we've sort of discussed at the start, and just be a little bit more attentive to the stocks that we hold right now, right? So, because we're certainly not in this in a trajectory up at the moment, right? So, thanks a lot, Jace. Thanks for another great week.
Hey, thanks, Rog. Thanks, viewers, for joining us. Been fun as always, and look forward. We'll go through some more stocks and some more markets next week.
For sure. Don't forget, obviously, to like and subscribe down below, and also leave a comment if you would like. That would be great. You can always go and check out Jason, a motion trader, right? So obviously, he's the man behind all the ideas and all the analysis behind this show. So make sure you go check out some of his great stuff over there at Motion Trader. And if you don't have an account with Selfwealth, obviously you can get 10 free trades below as well. All right. Otherwise, let's catch everyone next